Was I muted there? All right. Sorry about that. Where did I mute myself at? Oh, all right. Well, we'll start from the beginning. All right. All right. Well, here's me. I've been trading for about 10 years. I was a floor trader for about 10 years. Been in the business for almost 15. Really, my first job in finance was when I was 19. I have, at Option Pit, we have clients that are managing as much as $1,500 and as much as $15 billion. I work with some very large funds, and on the consulting side, where I'll go in and try and break what they're doing, or I'll do stress testing, things like that. And then I deal with individual retail clients that are looking to trade. And the big thing that really separates us is we consider ourselves traders who teach, not option mentors. I think the term option mentor means I'm kind of done actually doing my primary job, which is trading. And I consider trading and the business of trading to be my primary job. Mentoring is a part of my business, but it's really, the guys who taught me how to trade were full-time traders that took time to teach, and that's the way I consider my own students, and I hope that someday they teach somebody else how to trade because a full-time trader taught them how to trade. So, what are we going to talk about? Volatility can act like a headwind or tailwind to successful trading. We're going to cover basic buy-sell decisions to profit from directional trading. We're going to discover how strike selection can make the difference between a good trade and a bad trade. We're going to talk about a combo involving strike selection and buy and sell that I use on a regular basis as part of my trading. And then we're going to talk about a tip for swing and day traders. And all told, I'll have you out of here in 40 minutes. All right, you're going to learn a ton now. Options and stock. The key to trading options for direction is understanding the term correlation. Correlation means how one instrument moves with another. So if two instruments have a correlation of 1, that means the two will move together perfectly. All right. If they have a correlation of -1, that means they move opposite of each other. Correlations can go way bigger than 1, and they can go way under 1 in, or way below -1 in, how a levered ETF versus some other ETF might act. But with options, all right, the correlation of an option to its actual underlying. So an option on Yahoo can never correlate more than 1-to-1 with Yahoo or less than -1 versus Yahoo. All right. So now the term delta, right? And delta is the option term for correlation. In math, this can also be called slope. All right. Delta can change with the passage of time, change in price, or with one other factor that I'm going to talk about. So, there are a lot of different definitions, but the one that we really do use is correlation of an option to its underlying. All right. So, options with a positive 0.6 delta will make 60 cents for every dollar the underlying rallies. All right. That option will lose 60 cents for every dollar the underlying falls. And yes, there's gamma and other things, but just for now, let's just remember that 60 delta, 0.6 delta, means it will gain or lose 60 cents just like if the underlying goes up or down $1. Now, what makes delta so difficult relative to just buying the stock, all right, is that delta can change, all right? there's some drivers in Delta that are easy to understand, like price movement and the passage of time. All right, but one in particular, volatility, can have a real strong effect, all right, on Delta. All right, and really, volatility is going to end up being the #1 determinant of success. So, has this happened to you? And I get this a lot, all right? Mark, market makers are cheaters. I bought all these calls right before earnings. The stock is way higher, but I'm not making any money, all right? Market makers are taking my money, all right? The fact of the matter is no one is taking your money, all right? Inputs into the Delta changed. So let's take a look at IBM. Give me 1 second here, folks. IBM just had earnings yesterday, right? So I want to show you is how IBM can really change things. All right, so let's look at a chart of IBM. All right, and you can see they had earnings after the bell last night. So let's look at IBM. All right, it was up $5.50. All right, now today, let's say you said, okay, there's no way IBM is going to do that well. All right, I think IBM is toast. I don't like the stock. I hate everything about it. And so you're in your infinite wisdom. You say to yourself, I'm going to buy the May 160 put. All right, the May 160 put. Well, today, what's happened? IBM is down, right? Everybody see this? Now, with IBM down $2, all right, what was the delta of my 160 put, my May 160 put? I had a 29 delta, or 30 delta. So with IBM down $2, according to what I have here, I should make 30 cents a contract for every dollar. All right, so what's 30 with IBM down $2? What is, how much should I make on these puts if I bought them? Well, it's pretty simple, right? 0.29 times 2. Should have made about 58 cents. Does everybody understand that? So my puts that are 195 are going to be, according to my model, I think I'm super smart, they're going to be worth about $2.50. Now, how much do you think these options are actually worth today? Without cheating. How much do you think these are worth? You think more or less than $2.50? Let's just go there. Correct. A bunch of people said less. And the answer is a lot less. All right. Can I run that again? Yeah. So the option yesterday closed $1.95. It's a 29 delta. The stock is down $2 today. All right, so 0.29, well, it's a negative 0.29, really. So it's really negative 0.29 times negative 1.9, or really negative 2. 29 times negative 2. Well, this is not doing what I want. 0.29 times 2, and I get 58 cents. Why the negative? Well, it's really a negative delta, right? Because puts have a negative delta. And we're going to talk about this, all right? But, so the point is, I make 58 cents on the put plus the $1.95. Why 0.29? Because that is the delta of the put. All right. So now today, no, the theoretical price yesterday was $1.95. All right. Today, it's worth $1.50. All right. In May, the May 160 put is worth $1.50. All right. Why didn't you make money? All right. Well, I'll show you. All right. This is a chart of the price action of the May 160 put on the right side. This red line here is implied volatility of the option. The implied volatility of the option goes from 24 to 17. All right, so that volatility went down. Now, one nice thing about IBM, and here's the reason why I use IBM as an example when I can, because CBOE actually puts out a VIX of IBM. So there's a publicly listed and semi-dynamically tracked volatility for this. All right. So does everyone kind of get the example I just walked through? I'm not expecting you to have it down to a science, but does everybody kind of get that the example I just walked? Good. So the answer is no one took your money. All right? The delta actually changed on you. All right? And this is because the delta is not real. It is not a real number. All right? Delta, correlation, is a model. All right? It's modeled risk based on inputs into a pricing model. All right? So, models are meant to give traders an idea of how their position might move, but they're not a hard number. Has anybody heard the term garbage in, garbage out? Yeah, that is what can happen if you have bad numbers going into an earnings. So yeah, one thing people will do is kind of try and guess how much volatility might move and try and price ahead of that. There are other things that can be done. But the thing to remember is that modeling is a very inexact science. All right? You know, I don't want to take any steps into the climate change debate. But, you know, the big argument one side makes is our models say, hey, this is going to happen or this is going to happen. And the other side says, hey, your model keeps breaking. All right. And that's really the key. All right. Ask me that at the end. Remind me to answer that, and I'll discuss that. So the point is that models are just that. They're only as good as what's going into it. And oftentimes, volatility is wrong in a model. So since delta can change on you and is modeled risk, picking the right option for the directional opinion is key. All right? Should an option be bought or sold? In the money, at the money, or out of the money? It all depends on the implied volatility. All right? So, what makes trading a volatility different than trading a stock? All right? Over the long term, we know where implied volatility of a stock or index is going to go. We do not know where the stock price is going to go. All right? So a stock, stock like Apple can go up and up and up and up and up. All right? And not come back down. There's no real mean. But the implied volatility of Apple will revert back. So here's Apple stock. All right? Just going up and up and up and up and up. Now, this is, again, another one of these CBOE published volatilities, VXAPL. All right, the VIX of Apple. And, especially if I pull in more data, it absolutely mean reverts. Look at that, the smoothness of that 200-day moving average, which is the kind of silvery line. And look at kind of how that 50-day moving average, which is the red line, kind of meanders around. All right, so what this really means is a stock price can go anywhere, and while volatility can go anywhere, it can't stay there. All right? At some point, it has to revert. The VIX went to 90 during the 08 crisis. It's now 12. All right? Eventually, it'll go back to 30 or 20. All right? So understanding where volatility is within a cycle, all right, and where volatility is in overall is really the key. All right? So let's talk about the basics. All right? Basic buy-sell decisions in trading for direction. All right? In general, when implied volatility is low, all right, and especially in the long term when IV is really low, and one wants to play direction, even in weeklies. So someone said, oh, you don't have to worry about volatility in weeklies. You absolutely do. In fact, volatility is maybe, except for maybe the final expiration day, volatility is more important in weeklies. All right? And certainly the pricing model is more garbagey during the final week of an option's life. All right? So when IV is low in the near term and especially the long term, you want to lean toward buying options. And there are absolutely times where, even in the weeklies, buying is better than selling. I did a presentation a couple weeks back on weeklies, and people are always blown away that there are sections of the curve where it's cheaper to buy where there's less decay, and it's cheaper to buy a weekly option than a monthly option. All right? Now, when IV is high, all right, or normal, it typically makes more sense to sell options, on or call or put spreads. All right, well, that's what we're going to discuss, Jeff. Don't worry. All right, so now, when one wants to go long, one can sell puts or buy calls. All right? Each trade acts very differently despite being long the underlying. All right? A short put is long delta and short vega. Thus, the trader is hoping the stock moves higher and the implied volatility comes in. All right? What makes the implied volatility drop? All right? Implied volatility drops because the stock stops moving, or expectations for the stock to stop moving, for the stock to slow down, increase. So when you're thinking about selling a put or selling a put spread, instead of thinking a stock's going to go up, you need to be thinking that the stock is not going to go down. So GE, I don't know, these low vol stocks, Microsoft, stocks that I think aren't going to drop. All right. So that's kind of how I want you to think about that. So here's JP Morgan, all right? And JP Morgan, they have earnings. Stock takes it on the chin. This is last earnings cycle. All right? And you see that the IV is, while it's somewhat down after earnings, it still stays kind of high. And it gets to this kind of 55-ish level. And I say to myself, well, I don't know if JP Morgan's going to go a lot higher. All right? But I do think the stock is not going to go down. And so what do I get to do? I sell a put at, I don't know, $1 or $2. And I'm in a position where, yeah, the stock does move higher, but the volatility drops as well, and so I was quickly able to cover that put. So that's really how, so the way you think about implied volatility is kind of in twofold. Where's volatility kind of in the last couple of weeks? All right. But also, where is it over kind of the last 6 months or a year? All right, and that's kind of where stuff, that's really how you gauge this stuff. So when I'm looking at this, I see, okay, there's not a lot of events. The volatility is, we're after earnings, and the volatility is about as high as it gets, both in the near term and kind of in the long term. That's the time to sell a put. All right, so now let's talk about long calls. All right, a long call is long delta and long vega. All right, the trader is hoping the underlying goes up and vol goes up. All right. So what makes that happen? An increase in movement, an increase in expected movement. You buy calls in stocks that you think are going to go higher. All right. So you buy a call in CSX. That was one that I saw today. That was an easy dollar one that we did. But here's one in CF. And again, these are all from January, but I could pull up some ones from this week. All right, we did a trade in CSX this morning that made money in a couple of hours. Michael Kors, same thing. Although that was long puts. So you see volatility kind of hits these levels where it just doesn't seem to go any lower. So you've got a channeling stock and you've got volatility kind of dropping and to a point where it's about as low as it gets. And I'm saying to myself, okay, oh, this is Costco. All right, Costco is about as cheap as it's going to get. I don't know why this says CF, but I'm going to fix that. Let me get that. But I'm sitting here and saying, okay, Costco, I think it's going to move higher. And lo and behold, the vol runs and the stock makes a good move. It was it was a great trade. I do remember this. All right, so now let's talk about getting short. All right, like going long, when one is making buy-sell option decisions, you take implied volatility into account. All right, the point is don't just blindly sell puts or blindly sell calls or blindly buy puts and buy calls. All right, when IV is high and one thinks the stock is going to go down, you sell calls or call spreads. When IV is low and one thinks the stock is going to fall, you buy puts. That's simple. Here's IBM. Speak of the devil. And this is one where the implied volatility was really high. And look, a nice 162.5, 167.5 call spread does really well. All right? Even into earnings. You're not really, if you just pulled off here, you'd have made your money. Stock meanders a little lower. Volatility stays stable. If I'm selling here and buying back here right before earnings, volatility didn't really increase and the stock decreased. That's a win for a short call spread. All right, now here's one in IYR, which is real estate. All right, this is one I really like. So this was kind of into the whole, what about buying options when IV is rising and going higher? There is, that's a great question, and to active traders that know what they're doing and are experienced traders, I am a firm believer in that approach. But that is definitely a more seasoned trader's approach than a relatively new to options. This is more of a level 1, level 2 discussion than a somewhat experienced. But here's one in IYR where we're saying, okay, isn't the Federal Reserve talking about ending QE and volatility is at 11%, and this is a real estate index? All right, well, why don't we buy low, buy some puts, and lo and behold, the vol explodes and the underlying drops. All right, and it is so easy. If you get good at finding low-priced volatility, all right, if you get good at finding low-priced volatility, you are going to have a hard time losing on trades. What percentage is high and what percentage is low? So that's a good question, and the answer is it depends. It depends because every stock and every index has their own implied volatility cycle. What I will do is kind of give you an idea of like the S&P 500 or SPY. All right, if you follow the VIX, all right, there's kind of what I would call really low vol, then low to normal, normal to high, and then really high. All right, really low vol is about 15 to 20% of the time. low to regular volatility is going to be about, and that might be a 12 VIX. All right. Regular volatility is going to maybe be, I don't know, 14 to 18 in VIX. That's going to be low to regular. All right. And that's going to be 25, 30. That might be 40% of the time. Now, high vol in VIX, all right, so medium to medium high is maybe 18 to 22, and that might be another 30%. So we've got 20, 40, and 30. Really high volatility in the S&P is maybe at the high end, and that's above like a 22%, about 10% of the time, probably less. Now, here's one thing I will tell you. When the VIX goes backward, is volatility more likely to go up? When the VIX futures curve goes backward, is volatility more likely to go up or down? What do you guys think? In terms of, or let me rephrase that. When VIX futures are backward, when the VIX curve is backward, so front month futures are more expensive than back month futures, does the stock market have a positive expectancy or a negative expectancy? And see, this is a great one. We get a good mix. So here's the answer to that. More than 50% of the time, when the VIX curve goes backward, it is going to fall back to being in contango. All right? However, all right, so the answer is, should you expect the market to go up? Yes. Now, in terms of whether it has a positive expectancy, so would going long the market every time the VIX goes backward, would that have a positive payout if you did it every time? The answer is no. It has a massive losing payout. All right? It's actually a losing payout. So low vol of a stock is not the stock's IV relative to historical vol. That's part of it, but it's also relatively where the IV actually is in the cycle. It really is. So how much is a stock moving? That matters. But how much is a stock, where is the actual volatility? Yeah, that also matters, right? So believe it or not, if you were only long the market when the VIX curve was in contango, you would absolutely crush the S&P 500. All right, and if you try and only go long the market when the curve flips into contango or flips into backwardation, you would be a massive loser, because when you lose really bad, like 08 or 87. So, that's the whole thing. There are a lot of people that look at that like VIX VXV indicator, and it is a loser. If you go long the market when VIX crosses VXV, you are going to get your shirt handed to you one of these times, and you're going to lose everything you've ever made. All right, so now let's talk about strike selection. The next step is to select the right strike. All right, this is done based on the certainty of the next vol move. When one believes that IV is going to go up, one should buy a softer delta or an out-of-the-money delta. When one believes that IV is going to be stable or go down, you want to buy a hard delta. And we're just going to look at this from the buy side. We're not going to talk about selling for this section. But if you can figure out the buy side, you can figure out the sell side. Let's just put it that way. So a hard delta is relatively resistant to changes in volatility. All right, a soft delta is relatively dependent on a change in volatility. Understanding the difference can help with strike selection. So when would I want to buy hard deltas? All right, when I'm not sure of the next vol move, when IV is high, or when one isn't sure the severity of the expected move but wants to have limited risk. So let's look at Goldman Sachs. I'm going to buy calls right here. One could also say I could sell puts. That would be the better move, or the simpler move. But in this case, we're just going to buy. I'm going to buy a hard delta, or I'm going to buy a soft delta. So I can buy the Goldman Sachs December 110 calls, or I can buy a lot of the December 125 calls. All right? And you can see a week later how the payout goes. And you can see how the implied vol moves. So let's take a look at the payout. All right? So on 11/15, I can buy one of the December 110 calls for $7.60. I'm buying 70 deltas. Or I can buy 8 of the 125 calls for 96 cents and spend $768. Now, a week later, my one call is up about 50 cents. I make 305 bucks on one call. My 8 calls that I spent more money on, I made about half the dollars. And that is because of, one, look at the drop in implied volatility. This one drops 4 points. The 110 calls drop 2 points. So I wanted either an in-the-money option or I wanted to sell a put. You know, the best trade would have been, really, the 110 calls are the best trade. But, you know, another good trade would have been to sell like the December 115 puts. Yeah, so you do the opposite when you expect IV to increase. That's right. So now let's look at a soft delta. You buy soft deltas. When implied volatility is at its absolute lows, there is no better trade than an out-of-the-money call or an out-of-the-money put. I mean, that's what I'm really concentrate on. All right, and I'm great at doing it. And there's some very specific times where they can make a lot of sense. And the biggest is IV being really low. So here's IBM again. All right, IBM's around 190. The vol is just dirt cheap. And you can see the stock makes a nice move. So let's look at 2 trades. I can buy the 185 calls for $6.80, or I can buy a bunch of the 195 calls for $1.22. See a week later, I can get $9.30 or $2.25. All right, so on 121, IBM closes 190.29. I spent $680 on one 185 call. I spent $70 less buying 5 of the 195 calls for 122. You can see I buy a few extra deltas. 2 days later, the stock's up $3. Nice move. All right, my 185 call makes $250. Hey, not bad, you know. There's worse ways to make a living. However, my 5 195 calls are up almost 100%. So I spent less money and made more dollars. And that's because I was buying dirt cheap implied volatility. Makes a huge difference. All right, so now let's talk about this combo trade that I do. All right, so this is a trade that I do a lot. All right, I like to find stock. So I use LiveVol Pro a lot. All right, and the trade I like to do is I like to go in, find 52-week stocks that have IVs at their 52-week lows. And then I like to find stocks that are at their 52-week highs. And if I can find ones that are right near there, that are both in both categories, and I can run a scan that does both. So look at Pan, look at Palo Alto. That was there a couple of days ago. It's not today. But if I can find one that's in both of these. All right. All right, now you're saying, Mark, I don't have your fancy live vol execution. Fine. All right. Use the VIX methodologies the SIBO puts out for Goldman and Apple and IBM and those ones. Yeah. Well, that was a scan that hit last week. We actually were looking at that one very hard. Yeah, and the volatility got smoked. Where can I get your live vol? Well, this is actually an execution system, but you can actually get live vol as well. If you have questions about that, shoot me an email, marketoptionpit.com. All right, but you can. I mean, I use live vol X is has a lot more than live vol core, but both are good. And I have ways to get live vol core for free, actually. So use these VX indexes. And when they hit a 52-week low, at the same time one of them is hitting a 52-week high, try buying a 30 delta call. You will have trouble losing. All right? Now, additionally, here's another one. If a stock's implied volatility hits a 52-week low and it's been down for a few days in a row, try buying a 30 delta put. That was what happened with Michael Kors. That was an easy money. So here's Goldman Sachs. This was an easy one. VXGS absolutely tanks. So you end up buying right here. Which was basically the 52-week high, and you're buying the 52-week low in implied vol, and guess what happens? Boom, breakout, another nice move higher. It was really just an earnings follow-through. You know, a lot of times you'll see these stocks that have great earnings and pop way higher. They'll come in and overkill the upside calls. Very simple way to go in and buy. Yeah, I think Netflix did have one of those. Here's one that was in Under Armour that I did a couple of weeks ago. You know, the stock's right at that 52-week high. The volatility's in the absolute toilet. Buying calls. Vol goes up, the underlying rallies. All right, now here's a little tip for day traders. So look for a pullback with stocks near a 52-week high with low IV percentile. No. I typically look for a rally. Stocks with a 52-week, right near a 52-week high, and low implied volatility, I almost always want to buy calls. And what I'll do is I'll wait for it'll hit, and then it'll typically be down a little bit the next day, and that's when I'll step in and buy calls. A lot of times. When I want to go short is I'm looking for a stock that has been selling off and the implied volatility is selling off at the same time. All right. So a lot of people that follow ES and SPY and things like that don't realize this, but VXX and VIX futures almost always lead S&P and SPY. futures. And here's a good way to tell that something's about to happen. So if you're watching SPY and it's just kind of channeling around, you're saying there's nothing interesting here, and then you pull up a chart of VXX and you're seeing a slow rally, you know what's going to happen? SPY is going to fall out of bed. If you see VXX start to rally and S&P do nothing, SPY is going to fall out of bed. VXX is almost always right. Other way, same the other way too. So if you flipped around VXX and it was getting smoked and SPY was just in a channel, it's probably going to rally. All right, so notice, even though SPY is flatlining, VXX is slowly rallying during the day. All right, when I see this on an intraday basis, that is almost always a sign the market's about to sell off. It is one of the strongest indicators for a market turnaround. It really is. So, in summary, volatility reverts. Implied volatility helps form positions. There are different types of delta for different positions. Is the position sensitive to changes in IV? So do you want hard or soft? And remember that VIX and VXX lead. So now let me just give you my quick offer. So, trading debit and credit spreads for maximum profit. It is a 45-minute course. It's really good. You know, we sell it for $190, you know, $200 through Monday. $12. Now you're saying why? Well, I think that you guys are going to really like it, and it'll make you want to buy something else, quite frankly. All right? And so the first 100 traders to sign up, you go to HTTPS, exactly, a loss leader. You buy optionpit.com/option income. I don't think you need the S in there, to be honest. All right? You go to optionpit.com/option income. You pay $12 and you get this course. And it's 45 minutes. I'm not a time waster. You will get actionable and useful information that builds on this class, all and is standalone. Everything I do, if it's the last time you ever listen to me, you will walk away with value that can lead to improving your trading, I hope. All right? And this is just that. All right? So, trading debit and credit spreads, $12. No, thanks, Jan. So, check it out. And if you got questions, you can email info@optionpit.com. You can call me 888-TRADE-01. And yeah, I'll put the link here. Yeah, I'm going to email this out. Absolutely. That you'll get that tomorrow. You'll get the copy of this. Is there a link to your recording on weekly options? Yeah, if you go to HTTPS. On Saturday, I'm actually teaching a weekly options class. That's longer and more expensive. It's a live class on Saturday. It's going to be about, it's going to be myself and Andrew, my number 2. And we're going to teach for about 3.5 hours. It's $147. But on that page, you can actually find the copy of that thing. So what I would say is, you know you want to take that weekly class, by all means. All right? But if you're just starting to dip your toe in the water, income or directional class on weekly, it's actually going to cover both. It's going to be a pretty handy-dandy weekly trading class. But if you're just dipping the toe in the water, do the $12 deal. And like I said, if you got questions, feel free to email me. Both. So it's a live webinar class on this. Trading debit and credit spreads is downloadable. The weekly course is going to be live on Saturday, and then you'll get the recording. You know, I haven't fully finished the slides. I typically will work on them all the way up until about Friday, so I don't know if I'm going to cover back spreads or not. I probably will. I'm certainly going to cover front spreads, though. All right. Any other questions, comments? All right. Well, I know how to trade. Yeah. Is TOS platform have all the indicators to do this? They do have their own IV stuff. I just don't like TOS. I don't think TOS IVs are quite as reliable. And they have their VIX calculations are just so off. It's maddening. Yeah, we're going to send out the recording. Don't worry. And in fact, I think there's a recording of when I've done this in the past already up there. If I check, let me see. Let me see. Do I have a recording up there, a link to an old one already? Yeah, so nope, I will have a new one up there. I'll have the new one up there today. Yeah. Yeah, so we'll have the recording out shortly. Yep. Do I start earlier that there is a way to get live vol for free at minimal? Yeah, you know, if you have a brokerage account with live vol, they'll give you live vol X for free, and it uses Interactive Brokers as kind of their underlying. The other way to do it, and I've got a good deal there, the other one is there's a group called Tradier, and if you just want to open up a few $1,000s in an account, they'll give you live vol core for free. So live vol X, I think you need 35 grand in an account. Don't quote me on any of this. Tradier will let you open with as little as $1,000. And I can get you deals for both of those. All right, guys. Hope everybody has a great, yeah, Tradier. That's correct. All right, guys. I hope everybody has a great evening, and I will talk to you guys soon.